So friends, today I will be discussing about capital market, that is securities market. So securities market, as we all know, it is a marketplace where investments are bought and sold, and the securities market is divided into two types: money market and capital market. So I'll be discussing about money market instruments. Then I'll be discussing about the capital market instruments. So, what is money market? It is a place where short term securities of less than 1 year are bought and sold. And what is capital market? It is a place where long term securities of, that is, the securities of more than 1 year are bought and sold. And capital markets is further divided into primary market and secondary market. In primary market, the securities are issued for the first time, and in secondary market, already issued securities are bought and sold. So this is a brief introduction about the securities market, money market, capital market, primary market, and securities market. So coming to capital market, uh, so we know that in capital market, the long-term instruments, financial securities are bought and sold in capital market. Securities like equity shares, bonds, debentures, they are traded in capital market. Capital market instruments, they are the securities that are traded in the capital market. And according to Securities Contracts Regulations Act of 1956, securities include shares, scrips, stocks, bonds, debentures, and other marketable produces like securities of incorporated companies, other body corporates, and government. So, friends, to start with, I will be starting with the capital market instruments, that is equity shares. So what are equity shares? So these equity shares, they are commonly referred to as common stock or ordinary stocks. And the share capital of a company, that is divided into number of uh, small units of equal value, which we call it as a share. The term stock, so even equity shares, they are also called as common stock. It means the aggregate of number of equity, that is fully paid up shares of equal value, which is merged into one fund. Okay, so that is, if there are 1 lakh equity shares, so these total 1 lakh equity shares which are fully paid up, they are merged into one fund, which we call it as a stock. And it is a set of shares put together in a bundle. So equity stock, it is a set of share that is put together into one bundle. The stock is expressed in terms of money. Okay, the common stock, it is expressed in terms of money, and it is divided into any amount, and such amount can be transferred as shares. Okay, so the stock can be divided into any amount, and such amount can be transferred as the shares. Then the equity instruments, they are divided into many, like sweat equity shares, non-voting shares, right shares, and bonus shares. Sweat equity shares means it is a new equity instrument that was introduced in the company's ordinance 1998, and it should this sweat equity share should be issued out of a class of equity shares already issued by the company name, and it cannot form a new class of equity shares. The sweat equity shares forms a part of equity shares, uh, and these sweat equity shares are issued at a discount to the employees and the directors. And these issue shares, they are issued for consideration other than cash, for providing know-how or making available rights in the nature of intellectual property rights or value additions, by whatever name it is called. And in its first form, issue of sweat equity may be priced at a discount to the preferential pricing or as a discount to face value. And there are so many things to discuss about sweat equity shares. And for your knowledge, I think this much is enough. So that is, sweat equity shares are preferably issued for the current employees and the directors, and they are issued at discount. And why they are issued? That is, instead of paying cash for the employees and the directors who have provided know-how for the company, or also for making available some rights in the form of intellectual property, and also for value additions, they have been issued with the sweat equity shares. Then non-voting shares, non-voting shares, they will not carry any voting rights, but in addition to that, additional dividends will be provided instead of voting rights. And actually, this idea was widely discussed in 1987, and it was brought into existence in the year 1994 by the finance ministry, when finance ministry announced certain broad guidelines for the issue of non-voting shares. And these non-voting shareholders, they have right to participate in bonus issue, and they can be listed and traded in the stock exchanges. uh, and if these non-voting shares are not provided with dividends for 2 years, these shares would automatically get the voting rights. And the company can issue this to a maximum of 25% of the voting stock. And the dividend on non-voting shares would have to be 20% higher than the dividend on the voting shares. All rights and bonus shares for non-voting shares have to be issued in the form of non-voting shares only. So that is about non-voting shares. Then right shares. These right shares are offered to the existing shareholders at a price by the company. uh, are Such kinds of shares are called as right shares. They are offered to the shareholders as a matter of the legal right. And if a public company wants to increase its subscribed capital by way of issuing after 2 years from its formation date, or 1 year from the date of the first allotment, whichever is earlier, such shares should be offered first to the existing shareholders in proportion to capital paid up on the shares held by them at the time of such offer. And this preemptive right can be forfeited by the shareholders through a special resolution. The shareholders can re-announce the right shares in favor of the nominees also. And he may re-announce all or part of the shares offered to the shareholder, that is the existing shareholder. And the rights shares, it may be partly paid. Minimum subscription limit is prescribed for rights issues. In the event of failing to receive 90% of the subscription by way of issuing right shares, the company shall have to return the entire money that is received from the shareholders, existing shareholders. And but at present, the SEBI has announced that it has removed the limit, and it is rights issues, they are regulated under the provisions of the Companies Act, and also provisions of SEBI regulates the rights issues. Then coming to bonus shares. Bonus shares, it is the distribution of shares in addition to cash dividend to the existing shareholders. They are issued to the existing shareholders without any payment of cash. Why company issues bonus shares? As the aim is to capitalize the free reserves. That is, whatever the free reserves, in order to capitalize such reserves, bonus shares are issued. It is made out of free reserves built out of genuine profit or share premium that is collected in the form of cash. Bonus issue could be made only when all partly paid shares, if any, are existing, are made fully paid up. The declaration of bonus shares, bonus issue, used to have favorable impact on the psychology of the shareholders also, and they take this as an indication of higher future profits. Uh, Bonus shares, they are declared by directors only when they expect a rise in the profitability of the entity. The issue of bonus shares will enable shareholders to sell the shares and get capital gains while retaining their original shares. So this is about bonus, that is the equity shares. Next type of instrument issued in capital market is preference stock. The uh, characters of preference stocks, they are hybrid in nature in the sense some features are resembled as the equity shares. Some features of resemblance will be uh, of equity shares, and some features are of debentures. Some of the features resemble the bond and others as equity shares. Like the bond, their claims on company's income, they are limited, and they will receive fixed dividend. And at the time of liquidation of the company, their claims on assets of the firm will also be fixed. And at the same time, like equity shares, it is a perpetual liability of the entity. The decision to pay dividend to the preferred stock is at the discretion of the board of directors. In case of bonds, payment of interest is also mandatory. Dividend received by preference stock is treated on par with dividend received from the equity share for the purpose of tax, and the shareholders who hold preference shares will not enjoy any voting powers except when resolution affect their rights. There are some many types of preference shares, like cumulative preference shares, non-cumulative preference shares, convertible preference shares, redeemable preference shares, irredeemable preference shares, cumulative convertible preference shares. What are cumulative preference shares? Here, cumulative total of all unpaid preferred dividends must be paid before dividends are paid to the common equity shareholders. Uh, Whatever the unpaid preference dividends, they are known as arrearages. The arrearages do not earn any interest, but the non-payment of dividend only continue to grow. These arrearages accrue only for a limited number of years and not indefinitely. Generally, 3 years of arrears accrue, and the accumulative features ceases after the 3 years. But the dividends in arrears continue if there is no such provision in the articles of the association. At the time of liquidation, no arrears of dividends are payable unless there is a provision for them in the articles of association. Non-cumulative preference shares, as the name suggests, the dividends will not accumulate. If there is no profit or inadequate profits in the company in a particular year, the company does not pay it. At the time of winding up of the company, preference shares and equity shares are fully paid. If preference and equity shares are fully paid, they have no further rights to have claims in the surplus. And if there is a provision in the articles of association for such claims, then they have the rights to claim. Convertible preference shares. The convertibility feature makes the preference share a more attractive investment. The conversion feature is almost identical with that of the bonds. These preference shares, they are convertible as equity shares at the end of the specified period, and they are quasi equity shares, which gives the additional privilege of sharing the potential increase in equity share value along with the security and stability of the income. Then redeemable preference shares. If there is no provision in the articles of association, redeemable preference shares can be issued, but redeemable preference shares can be done. That is, redemption of shares can be done only when the partly paid up shares are made fully paid up. The fund for redemption is created from the profits which would otherwise be available for distribution of dividends or out of the proceeds of a fresh issue of shares for that purpose. If any premium has to be paid on redemption, it should be paid out of the profits or out of the company share premium. When redemption is made out of profits, a sum equal to the nominal value of the redeemed share should be transferred to the capital redemption reserve account. Next is irredeemable preference shares. This type of shares, they do not redeem except on occasions like winding up of the business. And in India, this type of shares was permitted till 15 June 1988, and the introduction of Section 80A in the Companies Act 1956 has put an end to this type of preference shares. Cumulative convertible preference shares. This was introduced by government in 1984, and this type of shares gives a regular return of 10% during the gestation period from 3 years to 5 years, and then converted into equity as per the agreement. According to the guidance of cumulative convertible preference shares, these can be issued for any of the purposes like setting up of new projects, expansion or diversification of existing projects, normal capital expenditure for modernization and working capital requirement. Then, but this cumulative convertible preference shares fail to attract the interest of the investors because the rate of interest is very low, and the gain that could be received from the conversion into equity shares also depend on profitable functioning of the equity. So this is one type of the capital market instruments where an investor have an option to invest in. So students, uh, hope you understood the different types of equity shares and also the types of preference stock, which are the two main instruments that an investor can invest in. Uh, in my next video, I will be discussing about other type of instruments, that is debentures. Then I will be discussing about bonds. Then, if time permits, I will be discussing about the primary market and the secondary market. So, friends, hope equity shares and preference share is clear to you. Thank you for listening. Thank you.